Hope you are doing great and you are fine. My name is Mauricio Hilbck. I will be the host today. I am a professor of finance and economics in the university, and I'm very grateful to see you all here in this new normal, by these platforms at least. This talk is going to be split in 3 parts: an introduction followed by the presentation itself for about 40 minutes, and then the last 10 minutes for questions and answers. Although there is little doubt that COVID-induced pandemic has adversely affected people's daily lives and the global economy, its impact on financial markets has been less straightforward. This talk will present a comparative picture of the impact, the underlying drivers, and the implications of 2 of worst economic crises that we have experienced in the last 14 years. First, the global financial crisis, GFC, in 2007-8, and the COVID in 2020 and 21. Whilst the genesis of the GFC was deep-rooted in financial system, COVID-19 is not a financial event caused by a global spread of a fatal virus. The talk aims to analytically compare the economic impact of the 2 crises and throw light on the emerging trends in the stock markets. The talk will be given by former professor at Cranfield, Dr. Sunil Poshakwale, who is a professor of international finance at the School of Management of Cranfield University in UK since 2006. He is also an adjunct professor to the Graduate School of Business of University of South Pacific in Fiji. Sunil has been a backbone of Cranfield's growth in finance research and MSc programs. As director of Cranfield Finance MSc programs until 2016, he achieved top 10 Financial Times ranking for its finance masters, got CFA recognition, developed a student exchange program with Freie University Berlin, and internationalized the program by launching it in Oman in collaboration with Muscat University. As a former director of Center for Research in Finance, he led the development of high-quality industry and policy-relevant research. He has published over 50 research papers, top finance journals, and present papers in many international conferences and seminars all over the world. He has successfully supervised many PhD and DBA students who work in prestigious university and financial services, both in the UK and worldwide. Sunil was named as the best professor of financial management by Asia's Business School Awards and as one of the most influential management gurus of Indian origin by Business India. He was named as one of the 50 top faces of Cranfield 50th anniversary celebration. He has wide-range research consulting experience as finance expert on several projects of African Development Bank on investment banks. His research on quality of corporate governance and fair performance has been used by MAFRE for launching a good governance fund. His work on gender diversity was used by March Gestión Fondos in developing their investment strategies. Well recognized for his finance expertise, he is regularly interviewed by print, radio, and television media, including BBC World Service, TRT Television, and Sputnik International. He has won several research grants as a principal investigator. Dear Sunil, it's an honor to have you here today with us. Hope you are doing great. Please, you have your time now.
Okay. So thank you very much, Mauricio. Let me first begin by thanking the Faculty of Management of the Pontifical Catholic University of Peru for giving me this honor to deliver this talk, what you call master talk, on this topic of analyzing the impact of COVID-19 and global financial crisis on the financial markets. It is, of course, very good to connect with Mauricio, who has been an excellent alumnus of our finance and management program at Cranfield. So I'm connecting with him after nearly a gap of 10 years. And that just shows how time flies. But it's lovely to see you, Mauricio, and welcome everyone. My intention is to keep my talk to around 40 minutes maximum, and then I'll be happy to take any questions you may have for another 10-15 minutes before we finish the session. The best way, I suppose, would be to use the chat function if you want to, and put your comments and questions there, and I'll be able to pick them up after the session, after I finish my talk. So, ladies and gentlemen, as Mauricio alluded to, COVID-19 induced economic shock has clearly affected people's daily lives and well-being of the global economy. However, when it comes to its impact on the financial markets, it's not always straightforward. Therefore, my effort in next 40 minutes is to talk about and compare the impact on financial markets of COVID-19 with the previous economic crisis, which we all probably, some of you will have in memory, was 2007-8 global financial crisis that was caused by the subprime lending in the US. Because I believe that such a comparison is going to be instructive as well as help us understand the causes and the implications of these crises, as well as the implications for policy interventions and how effective those policy interventions have been by the government and central banks around the world. Okay, so let me, and this is what very often happens to me. So I'll have to, when I'm on a particular slide for some time, it tends to get stuck. So I hope that I'm able to move it. Excuse me. Once again. Okay, so maybe I can, yes. Okay, so as I said, it is informative for future policy making to compare the two crises. So, as I said, though the financial outcome of the COVID-19 or the economic impact of COVID-19 has been quite widespread and well known, causing a significant reduction in the global growth. And I've just picked up some data from International Monetary Fund, which shows that globally the economy shrunk by about 3% or thereabout last year in 2020. It is likely to pick up growth and grow by about 5.9% next year, followed by slightly lower growth of 4.9% in 2022. Now, if you look at this graph, you will also observe that it's the advanced economies which were most badly affected in terms of shrinking of growth, 4.5%, compared to the emerging and developed economies, which also shrunk by 2% during 2020, but are likely to pick up and do slightly better, or in fact, much better than the developed economies. Now, if you look at the regional outlook, it provides you quite a bit of a variation. So regionally, the IMF projections suggest that it is the emerging and developed Asian markets which are likely to lead the growth going into the future, followed by the growth in Latin American markets, which you will be glad to know because Peru is part of Latin America, and then followed by the US, whereas the growth is likely to be restricted somewhat between 4 and 5% for Europe. Europe has been, of course, very badly affected by the pandemic. And so the larger drop in the European region is also reflective of the earlier onset of the COVID-19 crisis or pandemic, as well as the stricter lockdown that were imposed by the governments in Europe. So that's the picture we begin with, okay? Now, in terms of the, when we start talking about the two crises, that is comparing COVID-19 with global financial crisis, both in terms of impact and policy interventions, there are quite a bit of similarities between the two crises. But there are also distinctive differences in how the impact panned out, as well as how the governments responded, the central banks responded, the financial authorities responded to containing the economic contagion that arose from these crises. Yes, in both crises, businesses and financial institutions, banks collapsed. There has been a huge decline in oil prices. There has been high volatility in the exchange rates and stock markets, thus requiring significant financial help and bailouts by the sovereign governments. The reaction to the economic shock caused by COVID and GFC events was immediately felt in the currency markets. And that's what I'm trying to show you in this graph. So first, I'm showing you a graph which is capturing how the Great British Pound, the pound sterling, as we call it, the currency of the UK, how it depreciated against most major currencies during this period between 2008 and December 2000. So around October 2008 to December 2008, which was the period when there was a maximum impact of the global financial crisis in 2007-08. The impact of COVID-19 has not been very different. So if you look at it, there has been quite a bit of a significant reaction of GBP declining against most major currencies, particularly in that period when the pandemic hit Europe from about third week of March until about middle of April is the period when you can see a significant reaction in the currency markets. And so as you can see that during 2020 crisis, on the contrary, investors actually shifted money to the US securities in expectation of US dollar appreciation. So the delay in rise of cases in US also contributed to somewhat to this reaction by the investors. And during this period, according to the ONS, which is the statistical authority in UK, suggests that the UK GDP fell by as much as 9.9% as the pandemic affected every sector of the economy. So although during both events, sterling pound collapsed, it recovered much more quickly, okay, during the COVID event, largely thanks to quicker actions by the Treasury and the Bank of England, as well as by the government in terms of trying to provide relief through launching of various financial packages, as well as trying to come up with a vaccine and launching of vaccination programs. Okay, indeed, what is interesting to see here is that the currency markets and how they have reacted to the country's vaccination performance. So indeed, this has been an issue for a lot of multinational companies, global corporations, as well as investors and traders who trade in currencies to actually figure out which currencies are likely to do better following this COVID-19 crisis. And if you look at this slide, you will see that in relative terms, the UK pound, Canadian dollar, US dollars did well because these were some of the countries where they were able to successfully start the vaccination programs early and also start vaccinating higher percentage of population of those countries. Now, if you contrast that with other countries such as Japanese yen, Thai baht, which significantly underperformed, that was mainly because of the downgrades of the economic prospects of those countries, and also because of the low vaccination rate in those countries. However, there are exceptions. Despite low vaccination rates, for example, a few commodity exporting countries such as South African rand, Chilean peso did much better in relative terms. For example, the copper prices were quite stable during the COVID crisis. And as you know, the Chile's is a major exporter of copper, and copper export accounts for nearly 10% of the Chile's GDP. So the reasons for currency market reactions during COVID have not been necessarily straightforward. And also don't forget that the generous financial bailouts and quantitative easing and providing liquidity to the economy has also helped the valuation of some of those currencies. Okay, so now when we look at the stock markets reaction to the pandemic, the stock markets typically went through about 3 or 4 different phases. Okay, the first phase saw a rapid and significant decline in stock markets, followed by partial recovery during phase 2. For example, in the first month of 2020, there was a rapid decline on values of stocks in all sectors. And the slide shows performance of different sectors in the first and the fourth phase. So the slide that I'm going to show you, I'm showing you the performance of stocks of various sectors in the first phase and how it changed by the time we hit the fourth phase of the pandemic-driven shock. Okay. The extent of detrimental impact of the virus on all stocks in phase 1 is very visible here. If you look at the percentage declines in the value of shares of some of the sectors, mainly or notably aerospace, air travel, insurance, banking, oil and gas, the values of stocks of some of these companies in these sectors fell between 40 and 50%. In the second phase, by the time we hit June 2020, the gap between the high-performing, low-performing sectors actually grew, okay? With aerospace, air travel, oil and gas, etc., still lagging, and some other sectors such as pharmaceutical, biotech, health sectors started to recover on the positive news, of course, and higher demand for vaccine and pharmaceutical products also helped stocks of some of these companies. So by the end of third week of October, 2020 markets had nearly bottomed out and almost half of the sector had fully recovered, though the usual sectors were still lagging behind. Finally, if you look at the right-hand graph on this slide, which is showing you what happened by the time phase 4, we entered phase 4 of this development, with the positive news about vaccination and vaccine development and vaccination programs, some of the worst hit sectors started the recovery process, okay? Except for the aerospace, oil and gas, air travel, the usual suspects, again, banks, insurance, some of these sectors, leaving some of these sectors apart, most of those sectors you can see started to be in the positive territory, as shown by those blue arrows here, okay? However, the most noticeable thing here is that the difference between the high performing sectors and the low performing sectors actually grew, and it grew nearly from something like 30% in the first phase to something like 80% by the time we reached the fourth phase. Now, it has been a challenge for international investors in terms of trying to select markets in countries for investing, because the news has been bad from almost all parts of the world, although there has been some lagged effect of pandemic in many parts. And also some countries whose growth rates were revised upwards by World Bank, IMF, OECD, etc., because those countries were doing well on vaccines, for example, or vaccination programs. This did not necessarily translated into higher stock returns in these markets. So that's why it's a very interesting slide if you look at it. If you look at it, you will see that despite achieving a very high vaccination rates or relatively higher vaccination rates, the UK stock markets have relatively underperformed. On the other hand, emerging markets like Russia, India outperformed the UK, okay, despite having lower percentage of their population being vaccinated by the end of July 2021, because that's where this data stops. So you can see once again in terms of stock market reaction, the reaction has been mixed, and that is where the sector exposure becomes quite important in terms of which sectors have done better related to other sectors. So generally, investors were rewarded for investing in markets which had a larger exposure to growth and technology stocks or technology sectors. For example, the USA and Korea, South Korea, were the winners. So despite having the largest number of or highest number of confirmed COVID-19 cases in the world, in US, the S&P 500 index outperformed the rest of the developed stock market indices. In contrast, markets with greater exposures to something like value-oriented firms like Australia, they lagged in performance and they finished the year on a relatively flat note. Interestingly, over the past decade or so, with the rise of technology sector, growth stocks have outperformed the value stocks. Now, this is again another sub-theme which is very popular with the investors in the stock markets. And for many years, value stocks have been outperforming growth stocks. But this trend seems to have reversed, okay? Now, particularly during the last year, if you look at the data for last year, and yellow, of course, is the growth stock and gray is the value stocks, you will find that the difference in return between growth and value stocks has been significant, as you can see from this graph, the MSCI UK growth index has outperformed the MSCI value index by as much as 30%, okay? So growth stocks such as those from technology sector have not only benefited from greater reliance on technology, as we are doing currently, taking advantage of technology, but also from the low interest rates as seen from the sharp decline in government bond yields. So if we now turn to the comparison of COVID and global financial crisis, we see some similarities. So what are the similarities? Well, in both events in a way caused a great deal of uncertainty in the markets. And that uncertainty spread quite quickly across the world. So what we call a contagion spread across the world. In terms of the initial falls in the stock markets, the reactions were very similar in both events, or both events, in other words, caused collapse of stock markets, and as well as reactions. In terms of reactions also, there has been a massive monetary and fiscal support provided by the government agencies and central banks. But one of the ways to capture uncertainty is to look at stock market volatility. So in this diagram, what I tried to do is to look at how the volatility behaved, or how the volatility looked like, both during the global financial crisis, which is the top graph, as well as the COVID-19 crisis, which is the bottom graph. Okay, and as you can see that once again you see a significant increase in volatility around the period when the global financial crisis unfolded or was unfolding, which is of course September of 2008 to about November, December of 2008. If you look at the bottom graph, you will see that the volatility also picked up significantly, particularly during those months when the COVID infections and fatality rates were very high, particularly in Europe. And once again, you see a significant stock market volatility during that time period. However, there is one significant difference, that whereas the volatility seemed to have persisted for much longer time period following the global financial crisis, somehow the volatility has more or less returned to the pre-COVID levels rather quickly, or fairly quickly, following the initial shock caused by the COVID-19 crisis. Now, in terms of the genesis, or we know why global financial crisis was caused. Subprime loans, sub-quality loans, so low-quality loans, as we call them, were granted to what is known as American ninjas, and ninjas stand for those who have neither income nor jobs and assets. Okay, so these loans were given, then these loans were hidden into collateral debt obligations, CDOs, where the toxic risk was hidden in these subprime mortgages, which were then sold or transferred through securitized assets and other financial vehicles to other financial institutions and banks. So nobody knew where and how much the risk was in these bundle of CDOs that they were buying and selling. And when it was found, of course, the markets collapsed and there was a significant spike in uncertainty about economic policies needed to deal with this crisis. Okay. On the other hand, the COVID-19 crisis has led to suspension of trade, services, and commerce across the globe. Okay, because of the uncertainty about how and when the virus could spread. So the channels of this volatility, or the drivers of this volatility, are quite different from one another. Just as in global financial crisis, the market became highly risk averse. And as we can see that during both crises, the bond spreads increased significantly. So this was the additional coupon or return that corporate bonds had to offer to be able to raise money. Okay, if the company wanted to raise capital, they had to pay higher and higher and higher spread because of the uncertainty and risk aversion that these crises caused. So once again, you see that whereas after the initial blip, because nobody knew what was going on there was a significant increase in the bond spreads in the global financial crisis as people came to, more and more information became available to investors about what was going on with lots of institutions and banks who were in trouble. And so the more information about that came to the market, the more risk averse people became, and higher returns they wanted, okay, if they wanted to lend money to corporates. In similar way, if you look at the COVID-19 crisis, there was a significant spike in the spreads, okay, but then they fell relatively fairly quickly, whereas the spread persisted for a significantly long period of time following the global financial crisis. I remember even 2010-11, the spreads were quite high compared to historical averages. And that suggested that people were very, very risk averse. They were not willing to lend money at all. Or if they wanted to lend money or part with their savings, they wanted much, much higher returns. Okay, in terms of the collapse, you see from this graph that if anything, the impact of COVID-19 has been much more severe. So the major stock markets, such as the US here, and we are showing you the S&P 500 index and how it reacted to the news. It collapsed during both crises, but the decline was much steeper, okay, following the COVID-19 crisis, which is in blue, okay. So it took only 1 month for Standard & Poor's index to lose 1/3 of its value during the global financial crisis. For it to decline, it took nearly 18 months for the major stock indexes to fall by 50% or more and reach their trough during the global financial crisis. So it took much less time. It took much less time during COVID for markets to collapse. But again, as I said, the recovery has been much more quicker during COVID than during the global financial crisis. So this is simply showing you the interest rates and how they have remained historically low, how they were high prior to the global financial crisis, and how then they reduced and then kept on declining, while the central banks around mostly the major economies around the world were pumping in additional liquidity through quantitative easing programs, whereas the interest rates were already quite low before the onset of the COVID-19 crisis. So in terms of the reactions, the spillover effects of the global financial crisis, I was saying, spread through what we now know globally systemically important banks. During the COVID crisis, on the other hand, dependence on advanced economies on the supply chain with other countries was the main cause of market reaction, whereas it was the collapse of globally systemically important banks, the larger banks around the world, that those were the main reasons for global financial crisis. Yes, during following both crises, there have been a call for better coordination and more coordinated action, etc., by the governments. But in order to mitigate the and limit the impact of the economic shock, massive monetary and fiscal policy support has been provided. During both global financial crisis as well as COVID crisis, the government central banks have embarked on providing massive financial support, fiscal support. In the UK, for example, the Treasury provided 12 billion worth of financial packages. They reduced the interest rates by about 50 basis points. Also postponed the provided tax cut and postponed any impending tax increases, which allowed businesses to survive during the COVID crisis. In terms of the differences, the two crises differ again in three terms. One is the process, speed and shape, and policies. Okay, so both the global financial crisis and COVID crisis have affected the real sector and the supply of production, followed by the reduction in demand. So during the global financial crisis, the endogenous financial shock affected the demand side first, as the initial shock resulted in collapse of the real estate market in US to start with, and then that spread across the continent, therefore bursting the housing bubble in the US, and subsequently, therefore, the demand for housing also started to dry up. Interestingly, in 2008, banks were the source of the problem. Okay, As we know that Lehman Brothers was allowed to go bust, and they had significant exposure to these collateralized debt obligation CDOs, which meant that when the Lehman Brothers collapsed, there was a default on a large number of contracts trading in the derivative markets, and therefore the central banks and monetary authorities, when they realized the extent of the financial calamity that they had on their hands, they started to, with a massive fiscal and monetary stimulus, and also started this what is called troubled asset relief program, where then they purchased a range of assets which were losing value in order to provide relief to banks and other financial institutions. So it is estimated nearly 900 billion plus worth of fiscal stimulus was provided, along with the tax cuts in the US alone at that time. In contrast, during the COVID-19, banks have not really caused this problem. This problem is more a global health related issue which spread across the world. And due to the highly integrated nature of supply chains and physical contagion or physical contacts, the contagion actually or spread through the virus. Okay, so the supply shock that was experienced by a large number of companies then affected the financial sector and the demand side of for tourism, trade, travel, hospitality, and other services that we know about. Okay. So this slide is just showing you how the bond yields fell during both periods and how the recovery has been much quicker during the COVID crisis. Okay, then in terms of speed and shape, it is believed that the economic recovery following the COVID-induced shock is likely to be following a V-shape, and therefore the economic growth rates are likely to recover much more quickly. In contrast, during the global financial crisis, the recovery was U-shaped. It took much longer time period for the global economy to recover from the scars of global financial crisis. Another difference is that whilst the COVID-induced economic impact spread through government reactions, how well the governments were handling the pandemic, the COVID, what measures they were taking, whether they were able to develop and secure vaccines or not, whether they have started vaccination programs or not. The financial crisis were already brewing in contrast before 2008. And therefore, the subsequent recovery was much slower during the global financial crisis, as there was excessive leverage in both public and private sectors prior to 2008. So one major distinction is also that the global financial crisis brought a recession in developed economies, but on the contrary, the emerging economies, their growths were not as badly affected during the financial crisis. Yes, the growth rate slowed down because, after all, those economies depend on doing trade and business and for investments on developed economies, but they were not as badly affected. However, during the COVID-19 crisis, the impact on even developing and emerging economies has been as bad as the impact has been on the developed economies. Okay. So in terms of policies, as I said, massive relief was provided by both government and monetary authorities and central banks. The result has been that to a great extent, the economies have been able to recover much quicker because the government and monetary authorities and central banks, the federal agencies, etc., have been much more proactive during the COVID crisis than they were during the global financial crisis. Okay, now I want to talk about some interesting trends which are emerging after this COVID-19. And there are three interesting things to note. First is that a new group of exceptionally outperforming companies are changing the rules of the game here. And the pandemic has, if anything, accelerated this trend. So these firms were, in a way, already doing well, but they have done much, much, much better, maybe 10 or maybe 50 times better than other companies. And if anything, pandemic has actually increased that gap between high performers and low performers, low performing companies. And as I said, companies which were primed to do well prior to the crisis have in fact extended their lead over companies which have been not doing so well. Right, so this is a very interesting diagram which shows that over the past year or so, there are about 25 companies who have recorded massive increase in market capitalizations, okay, which put them in a category of their own, okay. And just to give you some numbers here, as this slide shows, collectively these companies added $5.8 trillion to their values, 5.8 trillion, okay. Now, on average increase across of the market capitalization or in the value of these companies, average across these 25 companies were $231 billion, okay. Now, it is estimated that the stock market capitalizations over the last year or so have grown by about $14 trillion, okay. So these 25 companies actually represent more than 40% increase of the total increase in total world market capitalization, which just goes to show how much wealth is now centered in relatively very few sectors and few companies. It's also worth noting that 22 of these 25 mega companies fall into four categories, as I said: North American technology, Chinese and Asian technology, electrical vehicles, and semiconductors. Okay, there are three other companies which are Chinese companies which rely largely on their own consumer, very large consumer market. Okay, so companies like Square, Shopify, PayPal, etc., are revolutionizing once bank-dominated world of payments as companies, as the markets are accepting more and more digital payments. 11 of these 25 companies, when at the start of the year, previous year, had a market capitalization of less than 100 billion. Some companies have added massive amount of value to their companies. For example, Zoom, which we are using for this talk, added nearly $93 billion to its market value over the past year. So there are 28 more companies which have increased their market cap by more than $50 billion. So if you add these 25 companies to, another 28 companies to these 25 companies that I'm talking about, then these 53 companies altogether account for more than 50% of the total increase in world market capitalization, okay, which is massive if you think about it, okay. Second, I mean, if you look at it on this slide, the trends that were driving the economy, the acceleration pattern existed or pre-existed the COVID-19 crisis. For example, online shopping, remote education are not new. These were, companies which were coming up anyway, but the COVID-19 simply intensified these trends, all right? And the big winners during the pandemic were already riding quite high. So if you look at the slides, this 25 group of companies in the top quintile, okay, in the top quintile, were significantly outperforming the market even before the COVID shock. On the other hand, weak market performance such as I said, banks, oil companies, oil and gas, travel, tourism, etc., in the middle and the bottom quintile were underperforming the market. The same forces that were driving the gap between the sectors are also amplifying the differences within the sectors. And this is, again, something which is quite interesting to look at. So why I'm showing you this slide is because I just want to talk about even the companies, the type of industries which face significant headwinds because of the COVID-19 crisis. Within that sector, some companies ended up doing much better than others. For example, while the restaurant industry, the hospitality restaurant industry, where you go and have nice meals, dinner, lunch, etc., where they were struggling, okay. Domino's Pizza, everyone knows Domino's Pizza, delivered a total shareholder return of 26%. And that is thanks largely to their technologically advanced business model and ability to adapt delivery system. Likewise, whereas rest of the gym industry was suffering because of the lockdown, nobody could go to the gym to exercise or swim or do their physical fitness routine. Peloton, which is a maker of internet-enabled exercise bikes, saw their value of their company double, or not double, sorry, 5-folds, okay, during this pandemic time period. So you can see that even within sectors, there are differences in performances, quite significant differences in performances of certain companies. And therefore, so overall, I want to now conclude my talk. The lockdown imposed on the economy to limit the contagion, of course, then necessitated the financial bailouts. So there was massive infusion of liquidity and financial help by governments around the world to minimize bankruptcies and loss of productive capital, as well as protecting the workers' skills. For example, in Europe and US, part-time work was subsidized by the government. In UK, there was a very famous furlough scheme that was launched by the government, where up to 80% of the salaries were subsidized to save jobs and limit unemployment during the COVID period. In addition, banks were provided loans at a very subsidized rates so that they could pass these loans on to help businesses, especially small businesses who were struggling to remain afloat because their cash flows had dried up. In terms of future, we are still not over it. There are still various different variants of COVID we hear every now and then, which seem to spring up or sprung up in different parts of the world. And so it depends on how the vaccinations go across the world, as well as how well we are able to tackle with these different versions of COVID. And as the international business, obviously, the process of international business in a way restarts, okay? But the hope is that the worst seems to be over. I think, having said that, infection rates in UK are still rising, and medical experts are calling this as a fourth phase of the pandemic. I hope this is the fourth and the last phase, and so we all can look forward to going back to our normal ways of life. And with that, I just thank you very much for listening to my talk patiently. I hope you found it interesting and useful. Thank you very much.
Thank you very much, Sunil, for your presentation and your very important insights that could help us to analyze the crisis and for further research as well. So it's the time of questions. So I think we have time for 1 or 2 questions, maybe because of time. So if you have any questions, you can raise your hand using Zoom features, or maybe you can write it down in the chat.
Yes, I did go slightly over time.
Yeah.
So, and I have to
problem.
unfortunately leave in 5-7 minutes. So if there are any questions, I'm happy to take.
Okay. Yeah, Abdulaziz, welcome. Go ahead.
Abdul
Thank
Aziz
you, Mauricio.
Wow, what a
Abdulaziz
surprise.
Idris, yes.
How is life in Ghana?
Yes, Ghana is doing well. How are you too, bro?
Abdul, I can barely hear you, my friend. And with the age, my hearing also not great. So you'll have to speak louder.
Yes, I'm saying that it's wonderful connecting with you once again. It's been a while. It's been a wonderful presentation. What I also wanted to request, probably if we can get the recording and then the slides as well. I don't know whether that is possible.
I think we lost him.
No, I'm still here, Prof.
I'm still
here, Prof.
You might like to just quickly type your question in case you have a question, Abdul, in the chat function, if you don't mind.
I think Abdul is asking for the slides. He's asking if you want to share your slides. Abdul, we will have the...
Comment, we can send it to you. I don't know.
I think there are issues with the slides. Cranfield is quite fussy about all these issues. I'm afraid I may not be able to share my slides, but yeah, I mean, I'm more than happy to kind of help you out. So how will the current rise of inflation affect finance? That's a good question. Yeah. How can managers protect their portfolio against this trend? I'm sure Leonardo has a big portfolio, right? Absolutely true. I think there is this risk of rising inflation because there's excessive liquidity in the economy is putting up pressure on the asset prices, and some people are even, beginning to wonder whether it is going to cause bubble or already caused bubble. For example, you saw this in this 53 companies cornering nearly 50% of the world market capitalization. Can you believe it? Just 53 companies. I mean, this is unbelievable. And so if you think about it that way, inflation worries are there for sure. There is already talk in UK, and I can give you some UK perspective here, that inflation might be sticky and that the interest rates might have to start going up in UK. Although they haven't yet decided whether they'll increase interest rates or not, it is more than likely that they might start to think about it. But they are also at the same time looking at the economic growth data, because what they don't want to do is disrupt this economic recovery process, okay, by raising interest rates. All right. So yes, so if the interest rates do go up, obviously all of the money that is pumped in currently into the bonds and propping up the bond prices and driving down the yields will have to kind of come out of bonds. So there will be a major reshuffling. If you hold portfolios which include bonds, then you have to keep a very close eye on what's likely to happen to the interest rates, because obviously increase in interest rates is always a bad news for bonds. Okay, and so you will have to come out of bonds, reallocate some of your funds into stocks. But the challenge average investor faces at this point in time is if you do want to reshuffle your money and into stocks, where do you invest? Do you invest in technology stocks? Because you might think that they are already quite pricey, and their price earning ratios are very high anyway, so they are not really cheap stocks to buy. So if you want to buy, for example, something like Amazon or Apple or any of these stocks, it costs you a lot of money for that matter. So yes, there would be those issues. You will have to probably, one thing that the crisis have taught us is not to worry about timing the market. So I don't think you should think about timing or anything like that. I think you should stick to your basic principles of investing, where you identify solid companies, you understand the business model, you understand how these companies are going to earn money, and then think about what these companies might look like or might actually fare. How will these companies fare given their business in future, and invest in those companies, and you will be all right. I have one more question. That will be the last question, I'm afraid. I'll be very happy to come and talk to you again if Mauricio invites me. In fact, I would love to fly to Lima to come and talk to you guys if you want. But I'll leave this to Mauricio and his in his school's budget for that matter. But I'm happy to come. If an expansion policy was applied about the global economy, such as lowering the interest rates, increasing liquidity, how can inflation be avoided? Yeah, I mean, you're right. I think the inflation is avoidable only if the amount of money that is pumped in is being utilized for the purposes for which they are utilized. For example, providing relief to the businesses, providing relief to people who are losing their jobs, making sure that there is enough liquidity in the economy so that there is the cash availability is not affected, and that the excessive liquidity goes into the productive sectors, the sectors which are likely to actually improve the growth of growth rate of the economy. Okay, now if that happens, then you don't have so much worry about inflation. But of course, we know that human nature is greedy, and very often people corner money, and then they tend to put money into a few asset classes they believe will do exceedingly well, and then what you next have is asset bubble, which of course is never a good news. There's never a good news for the markets. Okay. Mauricio and my friends, my apology.
Excellent.
It's
excellent, Sunil.
I have to.
Happy birthday. Happy birthday. Have a nice one. Have a nice one. Many thanks. Have a nice dinner.
Yes,
it's been a pleasure. Yes. It's been a pleasure to have you here. Many thanks again. Many thanks to everyone. It's been a pleasure to me to be the host today. And so have a nice day to everyone, and see you soon.
Well, thank you very much, Mauricio. Thank you to your school and the Pontifical Catholic University for inviting me once again. It's lovely to see Abdul, lovely to see Mauricio, some of lovely people that I have known when they were on our program. And thank you everyone for listening. And as I say, I'm more than happy to come back and share further insights on things as they develop. But for today, you will have to excuse me, and Mauricio knows the reason why I must go now. So thank you very much, and take care everyone, and hope to see you very soon again. Bye-bye.